Good morning. Welcome to the 20th lecture on economics, management and entrepreneurship. Today, we shall do a few exercises and revise whatever we had done in the last 5 to 6 lectures. To start with, we shall take a simple but very realistic example of accounting principles, how the ledger accounts are maintained and how the trial balance can be generated from the ledger accounts. From there, we shall calculate certain ratios that we had already discussed in our lectures in course of discussion on the financial statements and financial statement analysis. So, the first question is like this: an entrepreneur starts a retail business in April. The following transactions took place in April. Write the ledger accounts in the form of T accounts and develop the trial balance. So, the main question is that various transactions are given for the month of April and we have to write the T accounts, and from the T accounts we have to develop the trial balance, the balance sheet basically. Now, you will see that these are the different transactions. First is invested rupees 100,000, there is a mistake here, 100,000 cash. Then from that amount he purchased merchandise inventory for cash 35,000 rupees, again purchased some more merchandise inventory, this time on credit, which is also called open account, on credit for rupees 25,000. Then he sold certain inventory and the inventory had a cost of rupees 37,000, but was sold for a total of 90,000, of which cash was 25,000 and credit was 65,000. Together 25 and 65 is 90,000. However, the cost in the inventory was only 37,000. Later he collected accounts receivables because it was on credit. From out of 65,000 he could collect 15,000. And then accounts payable he paid up to 18,000. Remember that he had purchased merchandise inventory on credit for 25,000. So, he paid back out of that 25,000 18,000. Next, he purchased certain fixtures for displaying the items for rupees 36,000. He made a down payment of rupees 12,000 and he gave a promissory note for rupees 24,000, the remaining amount. The fixtures had a useful life of 36 months with no scrap value at the end of the useful life, meaning that this amount that he had invested for buying the fixtures will be depreciated in 36 months. Every month 1,000 rupees. So, at the end of 36 months there will not be any scrap value remaining for the fixtures. Next, he had a rental. He paid rupees 6,000 as advance payment. There is a mistake here. Paid rupees 6,000 rental at a monthly rental of rupees 2,000 as advance payment. The total was advance payment towards the next 3 months, towards the rent, towards rent for the present, towards the rent for 3 months. The rental agreement also called for a payment of 10% of sales in addition to rupees 2,000 on the last day of the month. Such a payment was made on April 30th. You will see later in transaction 12, the expiration of the appropriate amount of prepaid rental service was recognized. It means he paid an advance of rupees 6,000 and at the end of the month of April, the rental for April 2000 was recognized here as an expense. 4,000 remained as advance payment for May and June. In addition, in transaction 9, it says that the entrepreneur also has to pay in addition to 2,000 rupees for April and for every month 10% of the total sales that he can make in that month. So, remember that he had made a sale of 90,000 rupees, 25 and 65. This was cash, this was credit. So, of this 90,000 rupees, 10% is 9,000 rupees. He pays also as in addition to the rental of 2,000, he pays 9,000. Then wages and salaries amounting to rupees 40,000 were paid in cash. Depreciation expense for the fixture, as I was telling you, 36,000 was the investment, the purchase price, and 36 months was the useful life of the fixtures. So, per month 1,000 rupees depreciation was recognized. And finally, the rental of 2,000 rupees for April was also recognized. So, these were the 12 transactions that took place for the entrepreneur in the month of April, starting with his initial paid in capital amount of rupees 100,000. All these transactions took place in the month of April. We are required to find out, first of all, make the entries in the corresponding ledger accounts in the form of T accounts, and then develop the trial balance. Transactions, as you know, are given only for the month of April. Now, these are the entries. These numbers 1, 2, 3, 4, 5, etc., they are the transaction numbers. Now, first transaction was that the entrepreneur out of his own money made an investment of rupees 100,000. So, that was in the form of cash. Therefore, two accounts have to be created. One is his own paid in capital and the other is the cash. Cash is an asset for the company, whereas paid in capital is the owner's equity. It is something like a liability, but liability to the owner. So, it is owner's equity. So, if you recall, every T account has two sides. The left hand side is debit, the right hand side is credit, whether it is assets or liabilities. However, the interpretation of debit and credit would differ between if the account is an asset or if the account is a liability. In case the account is an asset such as a cash, the increase in cash would be entered, that transaction will be entered in the debit side on the left hand side. Therefore, as cash increased, the entry is made on the left hand side of the account, which is 1 lakh rupees in the debit side, whereas the company is liable to the owner to the extent of 100,000, that is his investment. So, this is credit side. So, if a liability account increases, the entry has to be made in the credit side. So, there are two entries. This is the double entry bookkeeping system. The asset side or the debit side matches with the credit side, two entries and they are equal. So, this is the first transaction. Now, let us see the second transaction. Second transaction says that he purchased merchandise inventory for cash at rupees 35,000. So, the two accounts involved are inventory and cash. His cash depletes or decreases by an amount of rupees 35,000, but his inventory position increases. Both are assets. Inventory is also an asset, cash is also an asset. So, we show inventory and cash as the two relevant accounts. Now, cash reduces by 35,000 for transaction number 2. So, transaction number 2, the entry is 35,000, but by this amount the inventory position increases. Both are assets, therefore, when increases the entry is made in the debit side, whereas the entry for cash is made in the credit side. Both again are equal, asset side and the debit side and the credit side, the entry is equal. So, this is 2, transaction number 2 35,000, inventory increases, transaction number 2 cash reduces by 35,000. These are the entries. Now, let us see transaction number 3. Transaction number 3 is purchased merchandise inventory on open account at rupees 25,000. So, here inventory position increases. So, the entry for 25,000 will be, this amount will be debited to inventory, entry will be made on the left hand side, but since it is purchased on credit, therefore, we have to create a new liability account, and that is accounts payable. Company has to make a payment later, not in this month. So, that is accounts payable, a new account has to be created. The old inventory account will be there. So, in that accounts payable account, the entry has to be made in the credit side, because the accounts payable increases and it is a liability. So, payable and inventory, these are the two relevant accounts. This is transaction number 3, inventory increases by 25,000, but by the same amount the payable also increases. Payable being a liability, any increase in liability, the entry must be made in the right hand side, meaning the credit side. So, once again the left hand side and the right hand side match. This is transaction number 3, 25,000 and 25,000. Now, we see the fourth transaction. Fourth transaction is merchandise carried in inventory at a cost of rupees 37,000 was sold. So, if the inventory of this amount is sold, the inventory position reduces. The entry for 37,000 has to be made in the credit side of the inventory. This is the first thing. Then this amount, which was purchased only for 37,000, could be sold for 90,000 in the market. So, the remaining amount is the profit, but this amount of 90,000 could not be, the cash could not be realized in the same month. He could get cash only up to 25,000 and the remaining was on credit. So, cash position increases. So, this amount will be debited to cash, cash being an asset. Open account means on credit, but he is selling, therefore, it is accounts receivable. He will receive this amount in the future. So, he is the owner of this amount, but not at the present. At a later point of time, he will get the amount of this amount of money. So, it is accounts receivable. This also is an asset of the entrepreneur. So, a entry for this will also be made in the left hand side of the accounts receivable account, that being a or this being an asset account. Remember that there is a mismatch. You will see this mismatch when I come to the accounts. Look at this. Inventory position reduces by 37,000 on account of transaction 4. This is sold. For how much? For a total of 90,000. So, we have to now create a sales account. This is expense and revenue account, and this will be credited. Remember that sales is like a liability. So, this will be put in the credit side, 90,000. Sales increases by 90,000. Cash increases by 25,000 because cash sales is only 25. The remaining amount is accounts receivables. It is shown in the next slide, accounts receivable on account of transaction 4, that also increases by an amount of 65,000. So, we have made asset side debit side entries for accounts receivables and cash, and that equals the credit side entry of 90,000. So, these figures match 25 plus 65 that appear in the left hand side of assets equals 90,000 that appears in the right hand side of the expense and revenue account. But this 37,000 also comes here as cost of goods sold. This is the amount by which the inventory decreased, and that is nothing but cost of goods sold. So, we have to show this as an expense. So, this is a cost and this got transferred as cost of goods sold when the amount was actually sold. So, this amount comes on the debit side, that is an expense on account of transaction 4. So, you see that this 37,000 appearing in the right hand side matches with 37,000 appearing in the debit side, whereas this amount 25,000 inventory, cash and 65,000 accounts receivable match with 90,000 sales. These are the entries. So, how many entries? One is inventory depletion, inventory depletion here, next is cash increases, next sales increases, and then accounts receivable increases and COGS increases. So, these are the various entries on account of transaction 4. It is quite little complicated, but I think there is a logic that I am sure you have followed. Next we come to transaction 5. This is to collect accounts receivable at rupees 15,000. Accounts receivable, this is an asset. So, if we collect this amount, so accounts receivable will decrease and cash will increase, because we are getting this amount in the form of cash. So, we show cash increases by 15,000 on account of transaction 5, and accounts receivable reduces on account of transaction 5. So, reduces, this will appear in the credit side, accounts receivable being an asset. So, cash also is an asset, it increases, therefore, it is the debit side entry, and you can see that the debit side left hand side and right hand side match. Now, we see number 6, pay accounts payable rupees 18,000. So, when we are making the payment, cash position reduces by 18,000. Therefore, the entry has to be made in the credit side cash being an asset. Accounts payable naturally also reduces. Accounts payable is a liability. If it reduces, the entry has to be made in the debit side. So, cash reduces by 18,000, this is transaction number 6, and accounts payable also reduces, but the entry is made in the debit side because payable is a liability account. So, this again the left hand side and the right hand side are matching. So, this is transaction 6. Now, we see transaction 7. In transaction 7, we are saying that the company, the entrepreneur, he purchases special display fixtures for rupees 36,000, of which 12,000 he makes down payment. So, 12,000 is the cash payment. So, cash position reduces, the entry will be made in the credit side, and he gives a promissory note. This is called notes payable. So, he creates therefore an account called notes payable. It is like accounts payable, but separately written because he is giving a promissory note. Normally, such an entry, such an account is called a notes payable account. It is like a liability for 24,000, and this is something like a fixed asset. Fixtures are something like fixed asset 36,000. So, these are the 3 entries that we shall make. Number 7, cash reduces by 12,000. This is cash, and then not furniture, I am sorry, this has to be fixture. Fixture this is an asset and it is a fixed asset. 36,000 is the amount. So, the fixed asset position increases by 36,000, the entry is in the debit side, and then payment is made for 12,000, the cash position reduces. So, it is in the credit side of cash, and we are creating notes payable as a separate account. It is something like accounts payable, but it is shown separately because the company has given a promissory note, and this is the 7th transaction for 24,000. So, these are the 3 entries. Once again 24 for 12th, 36,000 that appear in the right hand side match with 36,000, which is the fixed asset value appearing in the debit side of the accounts. Now, we look at transaction 8. Transaction 8 says paid a rental of rupees 6,000. The monthly rental is 2,000, but initially in the beginning of the month of April, an amount of 6,000 rupees was paid for 3 months, including for April. So, we have to make the entry. If the cash has been paid for 6,000 rupees, then naturally the cash position reduces. The entry will be in the credit side, cash being an asset. Now, what is the corresponding entry? The corresponding entry is that it is an advance payment. Advance payment is like an asset for the company, and that increases, therefore, the entry will be made in the debit side. So, cash reduces by 6,000 and there is an advance rental payment of 6,000 rupees. So, this is like a current asset. Any advance payment is a asset and that is a current asset. This is 6,000 rupees. So, once again left hand side and right hand side entry for 8 match. Now, we go to transaction number 9. Here the agreement calls for a payment of 10% of sales in addition to rupees 2000 on the last day of the month, and such a payment was made on April 30th. So, that is number 9. So, here a payment was made, that means cash position will come down, and this entry for this will be shown somewhere in the rental. So, as an expense. So, here we are showing this expense as rupees 9,000, and cash position also comes down here. So, number 9, cash position comes down, so credit side is credited to cash and debited to expense account. So, they are matching, and what is 9,000? It is 10% of 90,000, which is the sales. 10% of 90,000 is 9,000. The entries are here. So, that is transaction 9. Transaction 10 says wages and salaries for 40,000 paid. So, cash position comes down, and wages and salaries is an expense account. So, wages and salaries 40,000 and cash position comes down by 40,000. So, here this is transaction 10, amount is credited to cash, debited to expense account. Depreciation expense was recognized. Recall that the asset was purchased at a price of 36,000 rupees, and it was estimated that it will have a useful life of 36 months, and assuming a straight line depreciation, per month depreciation comes to 1,000 rupees. So, we show depreciation as an expense. So, that is here in the expense account 1,000, and by that amount it is not a cash payment. Therefore, we cannot put 1,000 rupees here. We instead show that fixture which originally was purchased for 36,000 rupees, its value, book value reduces by 1,000. So, this 1,000 rupees is the amount that we show as an expense for to be accounted for in the calculation of profit. So, this is the amount by which the fixture value comes down. So, this is transaction number 11. And finally, transaction number 12 says the rental service was recognized. That means, rental of 2,000 rupees is now recognized because this is the end of the month. So, rental we show as 2,000 rupees, already advance payment was made. So, from the advance payment 2,000 rupees will be reduced. So, advance payment we have written here, 6,000 rupees we had given an advance. We recognize that 2,000 rupees is now put as rental for the month of April. Therefore, advance remaining was 4,000 rupees. So, friends, we have now created the accounts, the ledger accounts. We have made the entries for all the transactions. Now, we have to find out the sum total for each transaction. That is what we have done here. For assets, the left hand side will be always positive, and for liabilities, the right hand side will be always positive. So, we just put the sum here. For example, 35,000 plus 25,000 is 60,000 minus 37,000. So, this is 23,000. Similarly, the sum total has been calculated and cash position is 20,000, fixture is 35,000, paid in capital is remains at 100,000, payable still 7,000 payable is there, and here there is something to see. There is a mistake here, this has to be 1,000. Now, from the expense and revenue account, sales was 90,000, all the expenses including the cost of goods sold, which was the inventory amount, this is rental, wages and salaries, depreciation, another rental, all this adds up to 89,000. So, when we subtract 89 from 90, our gross profit is 1000 rupees. Here we are not considering interest and taxes, therefore, this goes as earning 1000 rupees as retained earning. So, this is what we have done here. So, retained earning 1000, the expense and revenue is 1000, accounts receivable is this minus this, we still have to get 50,000 rupees. We have paid an advance rental of 4,000 rupees, but we have yet to pay because we had given a promissory note, notes payable 24,000 rupees. So, these are the sum total of each account. Now, what we normally have to do, assets we have to, all the assets we have to put in one place, all the liabilities and owner's equity we have to put in another place and have the trial balance, and that is what we have done in this slide. Assets, this is the fixed asset, the fixture 36,000 rupees minus 1,000. So, the book value is 35,000, inventory this, cash this, accounts receivable this and advance rental paid. Advance rental is also current account. All these 4 are current assets and this is fixed assets, and these 4 are our the liabilities and owner's equity. Of this, the owner's equity are actually these 2. This is the amount that he had paid in the beginning of April, and in April the retained earning was 1000 rupees. Therefore, the owner's equity would be 100,000 plus 1000, and the current liabilities are this, accounts payable and notes payable. Altogether this is 132,000 and this also is 132,000. So, they are matching. This, therefore, we have seen that balance sheet can be developed from the ledger accounts. Now, we go to the next question. Next question is based on the data that had been provided in exercise 18. The question is, for the trial balance developed for the earlier problem, find different ratios. These are the financial ratios: current ratio, quick assets ratio, debt equity ratio, inventory turnover ratio and gross profit margin ratio. I have not given the values, but the ratios can be calculated as this is current assets divided by current liabilities. Current assets, these 4 are the current assets: inventory, cash, accounts receivable and advanced rental, and the current liabilities are these 2, 7 plus 24, 31, and these add up to 97. So, this ratio, whatever the value comes as 3 point something, that is the current ratio. So, apparently the company is in a comfortable position as far as the liquidity is concerned. But as I told you, inventory is not as liquid as cash. So, sometimes we go for quick assets ratio that does not consider inventory in the current assets. So, what we do? We take not inventory, but the other 3. So, the other 3 are this plus this plus this, cash, accounts receivable and advance rental. That comes to 74,000 rupees, 50 plus 20 plus 50, 70 plus 4, 74. 74 divided by 31, and that is 2 point something, 2.5 or so, close to 2.5, which is also quite comfortable. Therefore, the liquidity position is very good, which means that the company can very easily meet its short term obligations, such as accounts payable, notes payable, etc. It can always pay from its own funds. Its cash position and its liquidity position is quite comfortable, quite good. Next is debt equity ratio. So, here the equity is the owner's equity. Owner's equity in this case is the paid in capital plus the retained earning. Paid in capital was 100,000, retained earning was 1000, totaling 101,000. That is the equity. And debt, in our case of course, we have very simple situation. Normally one should have considered secured loans, unsecured loans, all that, but in our case fortunately we do not have so many loans, we have only accounts payable and notes payable, which is 31,000 only. And in fact, as I told you last time, sometimes even accounts payable, notes payable, they are current liabilities, they are not concerned, because debt normally talks about the basically fixed or long term debts. So, in this particular case the company does not have any long term debt. So, if we go strictly by that, debt equity ratio will be equal to 0, but if you consider even current liabilities as current debts, then of course the value is 31,000 divided by 101,000, which is something like 0.3, which is quite less. It is as good as saying that the main funds are sourced from equity only and not through debt. Next is inventory turnover ratio. Please recall that inventory turnover ratio is says on an average how much inventory the company holds or the unit, the organization holds vis-a-vis the sales that it is making. If it can sell more, but hold less inventory, it means the inventory management policy of the company is extremely good. Whatever it is having, it is almost selling at the same time. On the contrary, if inventory position is very high and sale is low, it means that the company is not doing very well. It is having lot of inventory, unable to sell them. So, this is what is shown in inventory turnover ratio. We divide sales by inventory, and suppose the value is 5, it means that the inventory has turned 5 times. That is why the name turnover. And normally, if you recall, I told that inventory should be average inventory held, and normally the average is calculated by finding out the beginning of the month inventory, end of the month inventory, both added and divided by 2. In our case, unfortunately, we have only the end inventory, which is 23,000 and the sale is 90,000. Therefore, ratio comes to something like 3 point something, which is not bad. 3.4, 3.5 is not very bad. So, the company is doing well as far as its inventory turnover ratio is concerned. Next is gross profit margin. This is gross profit divided by sales. Gross profit in the month of April. Remember that this is only a monthly gross profit that we are considering. This of course is monthly sales. This amount is not very good. It is 1 divided by 90. It is something like 1.2%, which is not very high. Now, this is how we calculate various ratios from the balance sheet and from the profit and loss statement. By the way, where is the profit and loss statement? Profit and loss statement is somewhere here, the expense and revenue account. Although we did not write complete things, but at least we have written the revenue here and the various costs here. We have calculated gross profit. So, this is similar to a profit and loss statement. So, these two exercises have given you enough idea, enough revision on our whatever knowledge we had gained in the past on double entry bookkeeping system and on financial statements and on analysis of financial statements. Now, let us consider some more exercises. This is an exercise on job costing. Now, this question is something like this: the selected data concerning the past fiscal year's operations of a manufacturing company are given below in 1000 rupees. The beginning and the ending inventories for raw materials, work in process and finished goods are given. This is for a year. In the beginning of the year, raw material was 70,000, end 90,000, etc. The other data are the raw materials used in this year is 468,000. Total manufacturing costs charged to production was 864,000, and that included direct material, direct labor, factory overhead that was charged at a rate of 80% of the direct labor, and cost of goods sold, which came to 900,000. Three things are asked for. One, the cost of raw material used, the direct labor cost, charge to production, cost of goods manufactured and factory overhead. These are the various things that are asked for in the question. Now, we pictorially show this same thing. A similar diagram we had discussed when we discussed job costing. This is the fixed, this is the symbol for fixed resources, these are the symbols for variable resources. These are the accounts: direct material, work in process, finished goods, cost of goods sold. Of course, also we have here the factory overhead expense. Whatever is entered in black, the values are actually given: the beginning inventory, the end inventory, the initial value of WIP, the final value, finished goods initial, finished good final, these values are given, and how much direct material was used was also given. Okay. How much WIP was transferred to finished good, that was also given. So, these are 900 was also given. So, the whatever is given in the black and white, they are given. We are calculating, and the values asked for, they are written in red. First is that if the initial material, direct material was 70 and final is 90 and 468 was transferred to WIP, what is this value? So, it is basically this plus x minus 468 should be equal to 90. 70 plus something that we are getting, call that x, minus something we are giving away, that is 468, and the ending should be 90. If we solve this equation, x will come as 488. So, that is the value of direct material purchased. Transferred was 468, this value is given. Now, what is given? Direct labor is not given, but instead what is given is the initial value, the final value and the amount that was transferred. So, again we apply the same principle: 75 plus 468 plus DL, the value of DL is not known, plus this amount is 0.8 of DL, that is given. The factory overhead applied was 80% of the direct labor. So, if this is DL, this will be 0.8 DL. So, 1.8 DL. Therefore, 75 plus 468 plus 1.8 DL minus 864 is equal to 35. Solve this for DL, it came to 220. Therefore, 220 is the direct labor that was applied. 1.8 of that is factory overhead, that is 176. So, we have found out these two. This is given as 864. Once again, the beginning inventory is known, final inventory is known, and now we know this. So, what is this? So, it is this plus this minus y is equal to 120. Solve this equation, y will be obtained. Y is obtained as 884 in this case. So, that was transferred as cost of goods sold. What is given is that the total cost of goods sold is 900. Therefore, this amount must be under applied factory overhead. So, this is 16 under applied factory overhead. So, that comes here, and when we add this and the one that under applied and now finally applied to the COGS, these two together give a value of factory overhead, that is 192. So, for the problem given, we have been able to find out different missing values. That is a job costing situation. Now, we take up a exercise on process costing. In this example, we consider a company producing CD players in large number. So, it is large number, therefore, it is process costing. It is a continuous production. It has two departments, assembly and testing. The manufacturing costs in the assembly department during February are as follows. Direct material added is this. The conversion costs are direct labor and factory overhead, they come to 90,000. Total assembly cost to account for is 150,000. 150,800, I am sorry, there is a mistake here. $150,800. Now, the question has been simplified by saying that there is no beginning inventory for WIP. There is no beginning inventory for WIP. Suppose work on 19,000 CD players began in assembly department during February, but only 17,000 were fully completed, and further only half the labor had been completed for each of the CD players still in progress. This says that from assembly 19,000 CDs work started, but 17,000 were fully completed. These 17,000 consumed the full direct material, and of the 2,000 remaining, those 2,000 consumed also direct material, but consumed only 50% of the conversion cost. Compute the costs of unit completed and transferred to testing. Also compute the cost of ending work in process. This is the question. Now, we once again follow the 5 steps that we had discussed in our previous class on process costing. Completed number is 17,000, partially completed 2,000, each receiving 50% conversion. Therefore, the equivalent number is 17,000 plus 50% of 2,000, that came to 18,000 units. So, DM was received by all the 17,000, but conversion resources were received by 18,000 equivalent units. Now, this table gives us the other 3 steps. The direct material cost was 60,800, conversion cost was 90,000, totaling 150,800. This was to account for. We have found out the equivalent costs. The conversion for the conversion cost, the equivalent amount was 18,000, because 50% of 2,000 plus 17,000 became 18,000. So, per unit it is 90,000 divided by 18,000, which is 5 rupees, whereas direct material was received by all the 19,000 CD players. So, 60,800 divided by 19,000 came to 3.20, that is the unit cost. Adding up, this gives 8 rupees 20 paise. Now, we apply the costs first to completed and transferred to finished department. 17,000 had been completed and the cost of that was 8 rupees 20 paise. So, multiply 17,000 into 8 rupees 20 paise, the value is this. 2 units not completed, we know already 2,000 not completed and per unit 3 rupees 20 paise at this. So, this into this direct material is fully taken, therefore, it is 6,400, whereas equivalent unit is 1,000 at a rate of 5 rupees, that came to 1000 into 5, 5,000 rupees, totaling 11,400 rupees total cost. So, when we add this, we get 150,800. So, the units that are completed and transferred to the finishing department, the cost is 139 rupees 400 rupees, and to those that are not completed, it is 11,400 rupees. So, friends, we have taken up about 4 exercises on different aspects, starting with double entry bookkeeping system, then financial statements, then analysis of financial statements, then we talked of job costing and process costing, and later we will in a future class we shall take up some exercises on budgeting and other topics also. Thank you very much.